Welcome to the June Market Diary. So, for those of you who are just joining us, there are a playlist that you can watch for everything leading up to this. But to start off with, we're going to talk about big tech because tech came back with a vengeance last month. First of all, Microsoft, if you can look at the 2-month trend, just decided to do this. And it started to converge on where the estimates of where its moving average should be somewhere around 330, 335. So, obviously there are some days where there are some big dips and there have been some bad days, but you can see where AI was announced and yeah. Anyways, you can't even see where I bought it at anymore because it's up $88 from average purchase price. My average purchase price is below 260. Amazon, similar story here. I bought it below 95, so it's not even on this thing. It's up $38 and it's following its moving average. It wants to hover right around 125 as a low and right around 127 as a high for its average. And at the end of the month, it was trading higher than that. It's not now, but it was at the end of the month. Anyways, so that's just to show that there was huge growth. $38 going up and $88 going up is not normal for any stock. Even like growth stocks, like it's hard to stay invested and not think that something's in a hype cycle. So we're gonna put a pin in that and circle back to that later on in the video. So let's talk VU, because something that got into my head over the last month and a half was I really want to peg some of my dividends to something a little bit more stable, and VU is Vanguard's S&P 500 ETF. It came in 2010, so it's a 13-year-old fund, and it is very consistent with what it does and is a good vector for getting at least the benchmark of the overall market, and it's a good way to kind of temper the bubble I'm feeling with tech. Now, a little bit about VU. First of all, it does have a $1.58 dividend that has been going up over the last 5 years. It did just pay out at the end. It did just have its ex-dividend date at the end of June, so it is quite on the quarter of the year. So, March, June, September, December, that kind of quarter system. So it is very yearly based. So I just missed the ex-dividend date, so I won't see a dividend unless I hold this until September. Yield is 1.52%, which, because it came off such a bad year last year, is why this is so low. Typically, it yields about 14%. That's the average for this fund over the last 13 years. Expense. So, ETFs cost money. What a 0.03% expense ratio means that for every $1,000 I put into this, I'm paying $3 to them every year, to the fund managers, which is Vanguard. NAV, net assets under net asset value. So it's what is the total value of all the stocks they own divided by the number of shares outstanding. This should track fairly closely to the price of the selling price of VU at any given day. The day I put this PowerPoint together, it was 407. It is significantly lower today, and spoiler, I got in significantly lower than this. But that's what net asset value means, and I will do a better explanation of all this in future videos. Anyways, ETFs, over just doing the fund version of this, are way more tax efficient. Because of the way ETFs are structured, I'm not paying for every single time they rebalance the portfolio, buy or sell a stock, or I'm not responsible for that as an investor. I'm responsible for a couple of other things, but it's not as tax inefficient as buying the mutual fund version of this exact portfolio, because there is one of that. Also, it costs $3,000 to get even started in that mutual fund, and I'm only investing about $800 into this to start. It will be more eventually, but to start, it's just $800. So, problem though, here's VU's top holdings: Apple, Microsoft, Amazon, Nvidia, Google, Facebook, Berkshire, Tesla, that absolutely evil insurance company that I am so disgusted by. So yeah, we have a massive tech bubble. Let's not even talk about how overvalued Tesla is. I've made tens of thousands of dollars on Tesla. I've also lost tens of thousands of dollars on Tesla. It is a volatile stock, and I have very big history with it. Google and Microsoft are competing right now, and they're causing all of these stocks right here, minus Apple, but all these stocks right here are in AI hype race where they're trying to figure out what the best revenue producer is. So you're looking at something between, almost 20% of the fund right here. I think it's like 23%. Someone else can add it up. Just quickly doing math off the back of my head. But you're talking huge tech bubble potential right here. And if the tech sector goes down, this is going down. So that kind of worries me. That said, it does rebalance based off of total market cap. So whatever the investors in the S&P, the total market cap is, that is what VU is going to balance off of. If everyone decided to, let's say, sell Apple and Tesla, and everyone decided to buy, I don't know, IBM instead. I know I just chosen that as technology stock. That's 50 years old, but bear with me. So they sold all of Apple and Tesla, and every single one of them decided to buy IBM. And now IBM has the combined market share of Apple and Tesla. Well, this fund will weight that at about 9.1% would be what IBM would be weighted at in this fund. And Apple and Tesla would just be knocked out of the fund entirely because no one's invested in them. They went to zero in that example. But that's how this fund works. For now, because everyone has decided to throw all their money into these 7 companies collectively, this is how this is weighted. So, I mean, if the ship sinks, we all sink together is essentially how this is going to happen. So, like I said, I'm worried about a bubble. It's very overweight in tech. So here's Vangaurd over the last 2-ish months. As you can see, kind of had a giant rise. It was hovering right around here, so it's gone up about $15 in a fairly short amount of time. And this is its, 13-year history. It started way down here, about $100, and it has slowly made its way up to here, about $400, and that's over, a period of 13 years. This tracks the S&P fairly closely. I mean, right down to what happened with Corona, right down to it's just after the 08 crisis, but yeah. And you have a couple of other blips here, but my point is, it has a history of going in about this line, which means you want to be getting in right around 400, because if you're following this trend line, it's pretty much getting you right to 400. So that said, here are the dividends. As we can see, they've been growing year to date. So you can see 2013 was 311 for the full year, 2022 was 595 for the full year, and because we're at 150-ish right now per quarter, we're looking at about $6 for the full year, which isn't bad. Now, here's its holdings, as I said. 32% tech, that kind of scares me. 14% financials in a very bad financial year. Not great. Healthcare, I don't like the sector to begin with. So not thrilled with investing in this, but it's there, and it is a huge thing that people invest in because it's grossly profitable. Grossly profitable. Consumer services, something I'm more familiar with, 11%, which, okay, fine, at least I understand that. Same with industrials. Consumer goods, oil and gas. If you can tell, here's my portfolio. 1, 2, 3. I dabbled in financials for a little while, but here, here, and here. That was my single stock picking portfolio. Now, I did say I bid 2 shares at 407. That didn't fill the 2 days I tried to do it, and today I put a market order in. It did fill at 402. So I got in at like 402, 403. The exact number I don't know. Anyways, so here are the other Vangaurd funds, that ETFs that you could go into. This is the straight technology ETF, and this is the S&P 500 ETF True. VTI is every single company that is a publicly traded company. So whereas VU is only 500 companies, VTI is, I think we're somewhere around 3,000 companies right now. I don't know the exact number, but it's a significantly more, which means the weighting changes a little bit. High dividend yield is just going for dividend stocks that's paying a dividend, which is why the price is so low. Information technology, here's your QQQ equivalent. These two are fairly similar. Why there's such a huge price difference, or why this one went down when this one went up, I don't know. I don't track these two very much. I'm not a fan of technology. And then SPY is just VU, but with higher, it's just higher management fees, essentially. So, yeah. So why am I worried if it's not clear that I'm worried about getting into VU? Why the hell am I doing it? Well, I'm worried because of the AI hype cycle that's following blockchain hype cycle patterns. For the same reason I'm worried for my own portfolio, where Amazon and Microsoft is severely outperforming the rest of the portfolio. I'm worried that going into VU is just adding more exposure to that, because growth right now is outpacing future earnings, because the way forward PE works and the way price to book works and all this other stuff, you're paying future money for you're trading future cash flow from these companies for essentially what you think they're going to produce. Like if you have a 27 PE ratio 27 years from now, and all the tech stocks are in the high 20s right now. So if you're buying a share today, you're expecting it to pay off in 27 years. I don't expect some of these companies to still be here in 27 years. So growth is outpacing future earnings. And again, it's AI driven with no clear revenue uses. AI is awesome. It's going to be awesome in the same way the internet is going to be awesome back when pets.com was a thing. I lived through the .com bubble. I lived through a couple of bubbles. AI is showing the same hype cycle that blockchain showed, that the internet showed, that all these different things where AI is going to be the future, no doubt. Will the companies who have first mover advantage be able to find revenue use cases that make the current prices worth it? That I don't know. So let's get into some of the more tea-reading technical questions. Rebounding off of 2022 lows. So you're already having a dead cat bounce in these stocks where they got hammered in 22. So they had nowhere to go but up, and people are kind of seeking that old comfort of pre-pandemic, like, and even pandemic, just like YOLO money, where they just want that like infinite growth back. However, growth doesn't do good in high interest rate environments. It does quite bad in high interest rate environments. And we are rapidly approaching 6% and will probably pass a 6% interest rate, when we've been at 0% for the last 6-ish years, 5-6 years, maybe more. We've been at 0 for almost the entire duration of the 10-year bull market we had. No one knows what high interest rates does, at least not most people, because they either weren't alive for it or they were so alive for it that they are now the institutional investors that are already taking all this into account. So are we playing a game of hot potato, or are we playing a game of long-term investing? And I am very uncomfortable in this dueling environment where I feel like I'm just holding a hot potato. So let's talk about some of the actual companies. So Amazon, Microsoft, Facebook, all these tech companies had huge firing sprees off of the request of activist investors. There's one activist investor in particular who loves firing people. And not really great for when you have massive brain drain. I don't know if you've ever worked in a company where you start firing people that are necessary. I mean, look at the dumpster fire that is Twitter. They had to rehire some engineers. Granted, that one was 100% on Musk. That had nothing to do with investors, unless you count Musk as the sole investor. But like, Apple fired a ton of very, very smart engineers. Same with Facebook. Same, like, they didn't just fire like the marketing department. They fired broad strokes of the entire company. Microsoft wasn't immune to that, nor was Amazon. Actually, Amazon has a policy where you have to fire the lowest performing 10% of your people every year. So they already have a churn corporate culture, and Amazon already makes me uncomfortable with their hiring and firing practices to begin with, just because of brain drain and how that affects revenue. Because you might have to fire someone because they technically are the bottom 10% of your team, even if your whole team is a bunch of A-teamers. Like, smart people tend to come together, and if you have to fire your worst performing member of your best team, brain drain. It's a thing. Anyways, anti-consumer behaviors and FTC lawsuits. Yeah, all of these monopolies are starting to act like monopolies because high interest rates. They can't pretend to not make profits anymore, so now they have to go anti-consumer, and now they're going to start facing FTC and other lawsuits specifically around monopolistic behavior. You're starting to see some things with Microsoft with its Activision pushback, which is a whole different can of worms, and the FTC is asking all of the wrong questions with that one, but whatever, we can pretend like COD's not a dying thing, and the whole reason Microsoft wants to buy Activision is because of its mobile gaming money, but okay, sure, whatever. We can have that discussion in a later video. And Amazon is just privacy violation here, just data breach there, just selling illegal goods. I mean, Amazon is a dumpster fire of lawsuits right now. But both of them are in the AI game. So they're up because stunk goes brrrr. So yeah, they're overvalued for current revenue and net profit. I mean, Amazon's barely profitable right now, and AWS is not being able to pull the retail side over the web development side. And Microsoft's turning into a Berkshire Hathaway, where they're just a holding company for other companies. Like that is their revenue model at this point. And it's amazing to watch, and it's why Microsoft has been able to stay current much longer than IBM was able to, which they dethroned. And they are even fighting Apple, who, if you know the history of those two companies, like, Apple should have killed Microsoft, and Microsoft is the zombie that won't die. So, like, they will both eventually die. We don't know when, and current revenues are not telling me much. So, yeah, I'm worried about these two stocks, if you cannot tell. So, speaking of which, let's talk about this portfolio because it is dumb stupid. Okay, so let's look at Microsoft real quick. I put in almost just under 5,000. It's at just under 7,000. Amazon put in just under 5,000, just over 7,000. None of these other companies are doing those numbers. The difference between this and this is almost entirely down to the gains made here. I will tell you the exact percentage later, but it is a significant portion of my gains right now is from these two stocks alone. Oil and gas are getting killed, but they usually do in the summer, so I'm not worried about it. If they're getting killed in the winter, then we have a problem because, cold places need to be heated, and if they're not heating themselves with gas, then okay, now a major revenue source is gone and alarm bells are going off. Enbridge is having pipeline issues because this is the pipeline company. So the fact that they're running into even more pipeline issues is not great, especially seeing I'm using them as a dividend stock, and I'm not expecting their stock to go much higher than 38 or much lower than 34, but still, like, they're having their own issues on the inside. Exxon just is dealing with low gas prices and the fact that their CEO is actively trying to tank the Q2 earnings expectations, so who knows what's going to happen at the end of the month, but it's going to be a fun ride for these two this month. ARK is just quiet. It's this is the one that I should be the most worried about because it's lending money business to business in a almost liquidity crisis. So, I mean, it's either going to go really explosive or it's going to crumble and there's going to be no middle ground. Plus, the way ARK is structured is it's a subsidiary of a larger company who has to take 85% of the profits, which is why its dividend is so high, and diversify it out. Otherwise, it gets taxed as a different kind of company. And then, yeah, it's literally there just as a leverage shield in case all of the loans go bad. They can't harm the parent company. So, like, ARK's not exactly safe either. Like, I know this going into them. I've never explained why I went into any of these before in any of the other market things, but here we are. And Walmart is Walmart. I'm not going to see anything good come out of Walmart until Christmas when, Christmas, Thanksgiving, when people start buying crap. So, yeah, cyclical. I really should be buying Walmart right now, just in lieu of the Christmas season, but I'm not doing short-term profit taking, which is killing me because, again, Microsoft and Amazon. Anyways, big tech, as you can see, $13 dividend. It pales in comparison to the $1,800 profit that we've made since we've opened. Same for Amazon, $2,000. Pales in comparison to everything else, retail, oil, gas, and loans. Now, I'm going to lean over to the side so you can see, but that is a $91 dividend that ARK gave out. All right? Total profit and loss, including the dividend, is only $250. Enbridge, during this snapshot, is 44. Right now, it is not 44. Oil and gas is having a very bad July so far. Exxon, 310. Again, bad July, but at one point it was 310 up, and that's including the $84 dividend because they're another good dividend stock. And by the way, Enbridge is too, but for some reason, one, we're translating Canadian dollars into American dollars because Canadian company, but that also means I'm paying Canadian taxes, which is that $19 that's right here. So fun little thing that I have to talk with my own accountant about, where I have to write this off of my taxes so I don't get double taxed on the amount of this plus the amount I paid to Canada. Because technically my total dividends is only like $112. So yeah. Plus, then we get to Walmart. They've already paid out 2 of their 4 dividends. Actually, 3 of their 4 dividends this year, but I only caught the middle 2. And then, yeah, $522. Like, it's mediocre, but it's there. It's like, it's not losing me money, and I like it. It is the milk toast of this portfolio. It is not good. It is not bad. It is just there. So, did we recover from last month? I know I'm talking a little bit about June, but I'm recording this on a day that we had a slight bit of a correction. Not worried about that, by the way. It was a great buying opportunity. I love correction days because I can actually get in at a cheaper price than what I would get on up days. Like not a bad day for a correction if you're in a buying mood. Unfortunately, the things that corrected were the things I was worried about before today. Like, this is the second time I'm recording this, and when I recorded this on July 1st, like, I had the exact same feelings, just now it's being spoken more in the media, which is confirming my previous worries. So, like, yeah. Anyways, did we recover? Beginning of the month, we were valued at $37,500. End of the month, we're valued at over $40,000. Profit or loss, almost $3,000 month over month. Profit loss since open, almost $5,000. I don't need to tell you why that $5,000 is there. We've been over it enough. But did we recover from April? Because if you remember, April was a very red month. Yes, our 2-month gain, after we took the loss of $1,200 from May, we gained back that whole loss plus another $1,600. So, yes, we grew over the 2 months. But what about without big tech? This is the scary number I told you about earlier. Profit loss since open without big tech is only $1,135. Big tech is 77.5% of my profits. Let that sink in. 77% of my profits are just those two stocks. That is an issue. That is an issue where I should be selling. Like that is a massive balance of portfolio issue. So now you can see why I'm so aggressively worried. Like, yeah, I'm not going to hamper on it anymore, but if 78% of your entire portfolio is concentrated in two stocks, you have a diversification issue. So, dividends earned year to date, because this is going to lead you into some other investment things that you should be thinking about. Walmart's paid me $37. Exxon's paid me almost $85. Microsoft $13.5, and Bridge $112 after taxes. ARK almost $92. Schwab, yes, I managed to hold Schwab long enough to get a dividend, paid me $2.50, which means my total dividends year to date is $341.57. Now, if I've had this in the market for 4 months. Now, if I had a money market account with this $37,000, I would have made, at the current APY of 4.05%, which was the top 3 money markets that you could get right now. They're all it's the allies of the world. You would get $486 of interest from that money market account. In dividends alone, I am just slightly behind that, which you would know because my dividend yield is 3.8 something. So you can see I'm about 0.2% compounding behind that. But if you take into account the money I've made from the stocks, if I was to liquidate them right now, I've made $5,000 of profit. So I'm technically $4,500, $4,600 over what I would have made if I had just stayed in a money market account. That's the risk side of things. I'm being paid a premium of about $4,600 for taking on risk of investing in the market. That is the point of investing. Risk equals return. Hopefully, if you're doing it right. If you take dumb risks, you can lose it all. Been there, done that, do not want to repeat that. So, plan for July. Round out ARK to 200. When I made the PowerPoint, I hadn't already done that. I've already done that. VU entrance, same thing. When I made this PowerPoint, hadn't done that. Today was a really, really good day for buying things, really, really bad day for my portfolio. Also, listen to the earnings, because apparently everyone today decided to downplay what was going to happen in quarter 2 right after the Fed announced crap and right after everyone decided, hey, let's not make employees be able to be paid, and also let's fire 1% because we want higher unemployment. Like, I understand the economics, but like no announcement today was good, and like I have like 5 videos I could make just based off of some of these announcements. So yeah, today was a very interesting day for anyone who's studying economics, and a very bad day for employees, and very bad day for people who were like invested in the market, but great day if you're trying to make an entrance, bad day if you're trying to make an exit, and just a meh day for long-term holders like myself. Like, I don't care if my portfolio goes down 3% in a day. Like, I expect days where it could go down 10%. I'm okay with that. It's a buying day. Problem is all the other macro factors that are going in that are making me worried that I'm in a bubble, and having that confirmed after 2 weeks of me talking myself into thinking that. So, yeah. Speaking of earnings, here's the earnings calendar for July. I'm going to have a very busy 3 days. Both of my gases down here on the 27th, 1 hour apart from each other. These EPSs are probably different after today, because the CEO of Exxon decided to like temper expectations dramatically. Amazon, same deal. It's not expecting to be profitable here. Like, it's just like, can you show me a profit anywhere is what Wall Street is expecting. Microsoft's expecting huge things, by the way. Like, they have expectations. ARK, same deal. Not expecting much. Show me a profit and show me that you can maintain the dividend. That is all ARK's expectations. But yeah, so this will be a very busy couple of days where I'm going through earnings. So I'm looking forward to it. I was looking forward to it a lot more at the end of July. Like, this was a very, very happy and short market diary. But like, I actually need to say this more for myself than any viewer watching, because future Oberst needs to know alarm bells are going off at the very beginning of July, and make sure you're watching this month. You can't set it and forget it like you did in June. All right, rules of engagement, because these are kind of important. We did this. We did this. For the love of God, please do this. Do not sell early. Like, try to hold it in, my guy. Please. So, market definitely bottomed out because stocks went zoom. There might be a couple of traps. I'm not quite sure of their value. I have no idea about this. Again, this was always a risk that I was worried about, and none of my stock holdings have been held for a year, so I don't have long-term capital gains yet. I can't sell yet, so I am not a happy camper right now. And my dollar cost averaging strategy just went, all right, start putting things into VU. That became that dollar cost average strategy. So, yeah, like, there's risk. There's always risk, and there are things that are firing off as red warning flags in the back of my head, and I'm just like, stick to your plan, Oberst, long term. You want to hold it for a year. Just thick and thin. There we go. Even if you end up losing money on Microsoft and Amazon, maybe you won't. Maybe the market will be irrational through the end of the year. Let's see. Anyways, disclaimers. Please read them. This video has gone on for over 30 minutes, so we're going to end it here. Thank you so much for watching. Have a fantastic day, and I will see you in August for the July look back and see if I wildly overreacted to the first week of July and the amazingness that was June. Let's not take away how amazing June was, because June was amazing, and I loved June. Great close to the end of the half of H1 23, like, great end. Let's just enjoy June for a second and then go into July thinking the dog days of summer are not going to be so dog days. So anyways, thank you so much for watching. Have a good one. Goodbye.